if you had incentive stock options and your company is about to go public or has already gone public, you'll want to get a plan together to exercise and sell your stock. It depends on whether your company is going public with a direct public offering or a direct listing or a traditional IPO in terms of what exactly your options are. When a company goes public with a direct listing, they create a liquid market for the shares right away. So there's no lockup period, which is unlike a traditional IPO where insiders like employees cannot sell their stock typically for around 6 months after the IPO. Also, unlike a traditional IPO with a direct listing, the stock price is actually determined when the shares begin trading on the public exchange. So the market prices the value of the company, in real time. And this is unlike the regular IPO where the share price is decided the day before with the help of underwriters, and then the stock begins trading at that set aside price on the exchange once it goes public the next day. So for employees with incentive stock options, ISOs, a direct listing actually can offer really some key advantages. And certainly one of them is this no lockup period. So you can sell your stock immediately and also have some additional planning opportunities to manage the alternative minimum tax, to have cash needs to pay tax, and some different ways that you can kind of structure your exit strategy and diversification plan to fund other goals, reduce risk, and things like that. A traditional IPO is still a path to liquidity, but again, a lot can happen during that 6-month lockup period, and you'll really want to take extra care when deciding when to exercise your shares, whether it's before the IPO even happens or after, and how long, of course, you hold it for. You'll also need to consider the potential tax headaches and liquidity problems that can happen when you do eventually exercise your shares, depending on how long you plan to keep them for. So when you develop an exercise strategy, you'll want to keep tax implications in mind without letting the tax tail wag the dog. So as I'm sure you're aware, with ISOs, to be eligible for the favorable tax treatment, so for the entire profit amount to be taxed as a long-term capital gain instead of regular income or short-term capital gains rates, you'll need to have held onto your stock options for at least 2 years after the grant date and 1 year after you exercise it. Of course, there's a catch, and if you do exercise your stock and you have held it by the end of the year without selling it, the spread, so the difference between your strike price and the market value of the shares when you exercised, is included in your income calculation for the AMT tax calculation, which can trigger the AMT. And essentially, if your taxable income under the AMT parallel tax calculation is greater than under the regular system, you'll have to pay tax on the difference. So employees with ISOs with a large spread are much more likely to trigger this. So there are a few ways that you can tackle your plan for exercising and eventually selling the stock. It will really depend on your personal financial and tax situation. So it's really important to work with a financial advisor and an accountant in developing that. So for example, some strategies include exercising really early in the year. Sometimes it's advantageous to exercise before the company even goes public to get the clock ticking on the favorable tax treatment. Other times it's really good to just sell a tranche out upon exercise. Utilizing cashless exercise strategies can also help, ensure you're not really becoming underwater on these and limit the cash outlay that you need to provide. And then of course there's AMT tax credit you'll want to keep in mind. So when you do eventually sell the stock, choosing which tranches or grants to sell to accelerate that is another consideration. So really there's a lot of options depending on your personal circumstance, which is why it's really important to work with an advisor to get a plan in place. And the diversification component is also really important too. It's, what are your financial goals? How are you tracking towards those? how should you best use the proceeds towards funding those goals, and really reducing the risk that you have of this concentrated stock position. The markets can move really quickly, so it's really important to get a plan in place to turn, on paper profits into realized gains.